Welcome back to my channel. Today, we have some valuable insights to share with you on how to navigate a recession, straight from the legendary Warren Buffett. As the whispers of a looming recession continue, it's essential to prepare yourself and your investments wisely. By the end of this video, you will have deep understanding about Warren Buffett's 5 recommendations for what you should do before a recession hits. Let's go. So Warren Buffett's first tip is building liquidity. Warren Buffett once said, "Keep plenty of cash on hand so that people are going to keep making intelligent decisions rather than those forced upon them." This emphasizes the importance of liquidity, ensuring you have cash readily available to seize opportunities during a downturn. When you have cash on hand, you are not under pressure to sell investments when the market is down, or to take on debt on unfavorable terms. You can also take advantage of opportunities that arise, such as buying investments at a discount. Buffett has also said that he likes to keep a large cash balance because it allows him to sleep soundly at night. He knows that Berkshire Hathaway is financially strong and can withstand any market downturn. Of course, there is a cost to holding cash. Cash does not generate much income, and its value can erode over time due to inflation. However, Buffett believes that the benefits of holding cash outweigh the costs. For most people, it is a good idea to keep some cash on hand, but how much you need will vary depending on your individual circumstances. Some factors to consider include your income, expenses, debt level, and risk tolerance. Investing in proven companies. Buffett's wisdom extends to investing in challenging times, as he stated. Most major companies will be setting new profit records 5, 10, and 20 years from now. This reminds us that downturns are often temporary, and established companies tend to rebound over time. Buffett believes that most major companies will continue to grow and generate profits over the long term. This is because they have strong competitive advantages, such as brand recognition, intellectual property, and customer loyalty. Of course, there will be some companies that go bankrupt or fail to live up to expectations. However, Buffett believes that the overall trend is positive, and that investors who are willing to invest for the long term will be rewarded. Sticking with the normal game plan. Warren Buffett encourages a steady approach, noting, "We just want to buy good businesses run by people we like and trust and at a decent price." This business as usual strategy ensures you don't make hasty decisions during uncertain times. Warren Buffett is a big believer in a steady approach to investing. He looks for companies with strong fundamentals, run by honest and competent management, and trading at a reasonable price. He is also willing to hold his investments for the long term. This approach has been very successful for Buffett. He is one of the richest men in the world, and his investment portfolio has outperformed the market over the long term. Buffett's approach is a good reminder that investing should be a marathon, not a sprint. It is important to focus on the fundamentals of the companies you invest in, and to be patient. There will be ups and downs in the market, but over the long term, good businesses tend to do well. Avoiding no-growth assets. Buffett's perspective on growth versus cash is clear. Equities will almost certainly outperform cash over the next decade, probably by a substantial degree. Don't fall into the trap of locking up your money in no-growth assets. Maintain a balanced portfolio for long-term gains. Buffett's view is based on the belief that equities are a good way to invest in the growth of the economy and the profitability of corporations. Over the long term, the economy has a tendency to grow, and corporate profits tend to rise as well. This means that the value of equities is likely to increase over time. Cash, on the other hand, is a relatively safe investment, but it does not offer much potential for growth. In fact, the value of cash can erode over time due to inflation. Of course, there is no guarantee that equities will outperform cash over the next decade. There is always the risk of a stock market crash or a recession. However, Buffett believes that the long-term trend is positive for equities. Keeping a long-term outlook. Lastly, Warren Buffett reminds us of the importance of patience during recessions. Don't panic if you see your investments go down before and during a recession. The stock market will go up again, because history has proven that it always does. Maintain a long-term perspective and trust in the market's resilience. Warren Buffett is a big believer in the importance of patience during recessions. He knows that recessions are a normal part of the economic cycle, and that the stock market will eventually recover. In fact, Buffett has said that he sees recessions as an opportunity to buy stocks at a discount. He has also said that he is greedy when others are fearful. This means that Buffett is willing to buy stocks when the market is down, even if it means going against the crowd. He knows that these are the times when the best deals can be found. Of course, it is difficult to be patient when the stock market is crashing and your investments are losing value. However, it is important to remember that recessions are temporary. The stock market will eventually recover, and your investments will rebound. So, there you have it, Warren Buffett's 5 tips to prepare for a recession, all backed by his invaluable wisdom. Building liquidity, investing in proven companies, sticking with your game plan, avoiding no-growth assets, and maintaining a long-term perspective are key strategies to help you weather economic storms. Remember, as Buffett says, bad news is an investor's best friend. He believes that bad news can create opportunities for investors to buy stocks at a discount. When bad news comes out about a company or the economy, the stock market often overreacts and sell-offs occur. This presents an opportunity for investors who are willing to do their research and invest for the long term to buy stocks at a discount. When others are fearful, consider it an opportunity to scoop up assets at discounted prices. If you found this video helpful, don't forget to like and subscribe for more content like this. Thanks for watching.